Hello there. I wanted to visit with you a little bit today about debt consolidation loans. And I'm specifically talking about where you own a home, you have plenty of equity in the home, and you have some debts, and you're thinking about refinancing that mortgage to roll your debts into the loan. I often get asked, is that a good idea? Should we do it? Well, it depends. We're going to cover today the pros, the cons. I want to show you a really cool tool that we have that helps really take the emotion out of it and analyze to see should you do it or not. A lot of people have really low interest rates on their current loans right now, maybe a 2, a 3, or a 4% interest rate. Does it make sense to take a higher interest rate on current rates today in this refinance to roll in that debt? So let's get started. My name's Miles Pitcher. I own Superior Lending. I've been in the business. I've been in 22 years now. So first of all, debt consolidation really is just a refinance rolling in that debt that has higher interest rates in there and putting it into the mortgage. I don't know if you've been paying attention in the news, but we've had a few things happen that are really concerning. Number one is we've seen the consumer debt numbers skyrocket. People are spending and spending, and their consumer debts are going way up. The personal savings number has been dropping like crazy. So there's a lot of people who are in trouble on how much debt they have, and they're just really maintaining that minimum payment and not getting ahead. So we want to help look at a way that they can get ahead on their debt, get out of it, and build a plan to continue staying out of debt. So how does it work? It's a new 30-year mortgage that we do. I'll show you some details more on it here in a minute. So first of all, some of the pros is the low interest rate. Have you watched what your credit card interest rates have done? If you haven't, flip over to the backside of your statement and look at what the interest rate is. The average rate at the date of this video is 23.8% on the credit card rate. I've seen some also up in the 30% rates. So crazy interest rates. Home equity line of credit rates I've seen move up now anywhere from 8 to 12%. And then car loan rates have also shot up. So be aware that those have moved up. Streamline payments, it makes it super easy when you roll it all into one. You just make one monthly mortgage payment. Tax benefits, so this depends on if you itemize your taxes. If you just take the standard deduction, it's not going to help you. But if you itemize, paying this as mortgage interest rather than consumer debt, revolving credit card debt, car payments, this may help you also. It also gives you a fixed monthly payment that you can budget. And regardless of where things move in the economy, your life, you have a predictable, steady housing expense that you can count on. Let's look at some of the cons. So I don't know if this is a big one or not, but we are increasing your mortgage payment. We are increasing your loan balance, and maybe that increases the risk of foreclosure. I don't know if that's a huge deal. Long-term costs, again, you're going to be paying for closing costs all over again and doing this, but the savings could be worth it. But just be aware that there are closing costs. These are the upfront costs, and they have to be paid either rolled into the loan or out of pocket. Generally, we roll them into the loan. This is kind of the big one, is that you have to qualify for the new loan balance, and you may or may not be able to do that. A lot of times I see people who are eyeball deep in debt and they are struggling to keep up with it. As a result, their credit scores have taken a hit and maybe they're not qualifying. So just, work with us before it gets too late, too tough to take care of. Let's see if we can get it taken care of. In the most extreme cases, we look at it and we say, we can't help you on a mortgage refinance. Then the options become very limited at that point of what can be done. I'm not an attorney, financial advisor, but some people end up looking at bankruptcy. So another question that comes all the time is, why is the cash out refi mortgage better than doing a HELOC? So a couple of reasons is that we generally get better rates on our 30-year mortgage, and it is a fixed payment that's not an adjustable rate. Most HELOCs are adjustable, and most of them have higher rates. So it really can be a better situation. I see people do HELOCs to try to wipe out some of their debts, and it just ends up that compounding the problem, because you have to pay extra money every month on your HELOC to get ahead on it. Otherwise, you're just paying the interest and you keep that same balance and you're not getting ahead. All right, we're going to run through an example here. Let me make this bigger. So while there's no name on this, this is an actual client that came to me. See that arrow right there? It shows that we are at a 3.5% interest rate on this old loan. Okay. Over on the right, the green section is what we're proposing. And that is a current rate of 5.99. It shows the APR there. And let me show you what we're rolling in debt-wise. Before I do that, this is a little out of order. We measure right here what loan to value or how high we can go up. So as you're thinking about this refinance, just know that generally 80% of your appraised value is our loan limit on doing these debt consolidation loans. We look at our front end ratio, our back end ratio. Those are qualifying things that we can do. But the one I want you to see here is knowing that we can go up to 80% of the appraised value of your home. And yes, a new appraisal has to be done. All right. I know this is small in here, but let me show you the top bar up there shows what my client currently has in debts. They have a Visa, American Express, a student loan, and 2 car loans. We're going to take everything except the student loan and roll it into the mortgage. What we're rolling in has a total of $37,000 and currently has a monthly payment of $945. It just so happens that this client works in an industry where he's a state employee, and after a certain number of years, they will pay off his student loans for him. So those are going to go away then in the next couple of years. So we're putting everything into the mortgage. So you can see here that we're moving in that $37,600. Over kind of in the bottom right, you'll see his existing payment and his new payment. You'll see that we're taking him from $3,009 on his existing payment, which is the mortgage plus all those debts that we're talking about, and we're going to make it $2,824 a month. So how does this work out? How does it save him? $185 a month is what we're saving this guy. Now, if my clients so choose, and we highly encourage them to keep making the same dollar amount payment if they can, and put it into the mortgage, so that $185 a month is going as a pay down, my client's going to have this home paid off in 24 years. It would save 5 years, 8 months off the mortgage, and is going to save them around $82,800. So this is a sweet tool that we have. We are happy to take your situation, plug it in, get some numbers for you, and see if it makes sense. For this client, it totally did. We're getting them refinanced with a cash out refinance. And then there's a good chance here in the future that we'll even be lowering that rate again for them, lowering the monthly payment. So it's a good move to do. So just in closing, I am licensed in all 50 states through Plains Commerce Bank, and I also do loans in my company named Superior Lending. Here's my contact info. Feel free to reach out to my team. We're happy to run any scenarios for you. Thanks for watching.